Successful investors all have one thing in common. They have rules. Notable investors like Warren Buffett say to focus on fundamentals and management quality before looking at the price of a stock. Other major investors advise on betting big when you have an edge and to always be forward-thinking. 3 rules from 3 world's top investors. Number 1. Let winners run. Dennis Gartman says, be patient with winning trades, be enormously impatient with losing trades. Remember, it is quite possible to make large sums trading investing if we are right only 30% of the time, as long as our losses are small and our profits are large. His rule above addresses a number of mistakes young investors make. First, don't sell at the first sign of profits, let winning trades run. Second, don't let a losing trade get away. Investors who make money in the markets are okay with losing a little bit of money on a trade, but they're not okay with losing a lot of money. As Gartman points out, you don't have to be right a majority of the time. What is more important is to let a winning trade run and get out of a losing trade quickly. If you follow this rule, the money you make on the winning trades will far outpace the losing trades. Number 2. Do the research. Warren Buffett is widely considered to be the most successful investor in history. Not only is he one of the richest men in the world, but he also has had the financial ear of numerous presidents and world leaders. He says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett gives 2 key pieces of advice when evaluating a company. First, look at the quality of the company, then at the price. Looking at the quality of a company requires that you read financial statements, listen to conference calls, and vet management. Then, only after you have confidence in the quality of the company should the price be evaluated. If a company isn't a quality company, don't buy it just because the price is low. Bargain bin companies often produce bargain bin results. Number 3. Have conviction. Bill Gross's rule focuses on portfolio management. Good investment ideas should not be diversified away into meaningless oblivion. A universal rule that most young investors know is diversification. Don't put all of your investing capital into one name. Diversification is a good rule of thumb, but it can also diminish your profits when one of your picks makes a big move while other names don't. Making money in the market is also about taking chances based on exhaustive research. Always keep some cash in your account for those opportunities that need a little more capital, and don't be afraid to act when you believe that your research is pointing to a real winner. Bonus rules from other top investors. Patience is key. Investors that have strong convictions and have done the research are able to hold for long periods of time, riding out rocky market events. Be wary. When investing, you shouldn't take anything personally. Use your own exhaustive research based on facts, not opinions, obtained from trusted sources. Other advice can be considered and verified, but it shouldn't be the sole reason to commit money. Look ahead. Successful investors don't look at what's happening now. Instead, by studying the momentum of a company or an entire economy and how it interacts with its competitors, they invest now for what will happen later. They are always forward-thinking. Try to find the next big winner, but always anchor your portfolio with great companies that have a long track record of steady growth. There's a lot to learn from successful investors and their experiences. Each of these investors is known for being students of the markets as well as leaders. As you begin to apply these rules and commit to following them, even when your mind says otherwise, you should do well in the market. Increase your financial intelligence. We will upload more notes that will equip and empower you so that you can make the right financial choices and decisions in life.